What's going on, guys? Welcome back to the channel. In this video here, we're going to be doing a stock analysis on Under Armour. So some interesting news with this company. Recently got kicked out of the S&P 500. The stock price has been going down. And one of the board of directors bought, I think, a huge number of shares. So we're loading this up in the stock research tool built by yours truly. And stay tuned, folks. This will be becoming an app for you to use to analyze companies extremely quick. Anyways, jumping in. We're grading this company a 4 out of 10. Not a great score. The price has been going down. So let's see what Under Armour is doing right and what they are doing wrong. This is a very interesting business. They're in the sports field. They sponsor a lot of big name athletes, from Dwayne "The Rock" Johnson to Steph Curry to Tom Brady. Jumping in to the financial evaluations, scoring it a 4 out of 10. Let's see what this is all about. So with our 5-year PE average, we want to see this number to be 22.5 or lower. Unfortunately, we have it at 62.56. There's a lot of red here. Share dilution, we have low return on equity average, low EPS growth, or rather negative EPS growth. High debt to equity sitting over 50%, that's 65.37. Low return on invested capital average. So not looking too hot for Under Armour. However, the net income is growing, the free cash flow is growing, and their revenue growth is growing. Now, this is a huge free cash flow number growth here, folks, but the full story is this. Jumping into the free cash flow statements that we have here on my software, we go up to the free cash flow line, and to investigate what the full story is, take a look at that. In the negatives for years from 2017, 2016, 2015. And let's take a look at this. Of course, it's going to show a massive increase because now we're sitting at $595 million. So, yes, we are improving cash flows. However, they're not that great. And look at our average free cash flow sitting at $297. Do with that information what you will, but it's not looking too hot for Under Armour. So going into the income statement just to investigate what the revenue is looking like. So we've had a slight increase, but it's just been slowly growing over time. It's a very slow moving business. Looking at the financial statements of these companies, nothing really excites me about this business. They're not building the revenues up that much. What moves can they possibly make to improve business? They have a decent current ratio, but the debt to equity is also somewhat high. They're issuing more shares, which we don't like to see. We want to see this number decreasing, folks. Either decreasing or at the very least staying the same. What gets me excited about this business is when I see board of directors jumping in and purchasing stock of their company. I like to see that because I know that they care fundamentally about the business. Like an example would be the whole Twitter scenario with Elon Musk, where you had a very small percentage of shares actually owned by the board of directors. They don't care about that business. They don't care what happens. They like their cushy position, and that's it. But when you see board of directors actively making trades, and that's something I'm going to integrate on here on the software, where you see them purchasing shares, especially when there's a downtrend, that gives me a little motion of confidence. We're going to load this up in the price analysis section here, and this is another portion of my software where we can put assumptions in from 10 to 20 years, however you have it. I like to do 10 years. And we can find what a fair price to pay for this business would be. So I'm going to fill in these boxes and we'll talk about it in just a second. In my software here, did a 10-year analysis. We are doing some conservative numbers on revenue growth. Nothing too crazy because I know they can hit 4%. They've shown another 5-year. And I believe they can hit this 10%. I don't think that's being too overly dramatic, but I like to be conservative in case things go wrong. But in the event that things go right, and they crush my numbers, that gives me an ample margin of safety, and that's what we're trying to do here on the channel. We are trying to find companies at a decent margin of safety. If we are right, we win. If we are wrong, we don't lose too much. Speculating a little bit, but I've done 3, 4, 5 on a consecutive margin. Same thing with free cash flow margin. Price to free cash flow, keeping it fun, 12, 13, 14. PE ratio, 14, 16, and 18. Considering we're sitting at 19.59 currently. Desired return, lucky number 13. Let's see what we got here with Under Armour. Check it out, guys. Check it out. Currently sitting at $9.16 per share. We don't have anything on a conservative side, but our moderate and aggressive categories, are checking out. We are checking out with a decently low PE ratio, a decently low price to free cash flow ratio. Actually, it's somewhat higher than what we currently have. But low revenue growth number. This is the one thing, folks. This is the kicker. The low revenue growth. Now, if I just put in 5% revenue growth, does that? Take a look at that. We changed the revenue growth down to 5%. This is where I like to really start being finicky with the business. 5% revenue growth over the next 10 years. If we pay $986 today, we can assume to get a 13% return based off of these numbers here. If I did 6% revenue growth on this side, does that still check out? I'm assuming it does. Now, if I just did 5% with these other metrics, or let's say if I did 4.5, no, it's not going to check out. But 5% with a 4% profit margin, 5% free cash flow margin, these are extremely low number, folks. Extremely low numbers that I'm popping in here. Bringing our average calculation to $10 a share, we are pretty much at the fair value of this business. We have a slight discount on the company right now. So this is what I'm talking about, folks. When you see quality businesses, and I had a discussion yesterday with some friends of mine. We celebrated a birthday for one of my buddies, and if you're watching this video, I don't want to say his name out because he'll probably throw me an uppercut. But we had a discussion at dinner, and they were asking me about purchasing different companies. And my thing is this, and this is what I'm trying to promote on the channel. When you're buying a quality business and you see the price go down, you shouldn't be scared. You should be excited. You should be excited because now you're able to own a great business at a lower price. And here's the thing, folks, with investing and with anything that you buy, the one thing that confuses me the most is that people have more confidence paying more for something in the investment world than paying less for it. If you're able to pay less for a phenomenal business, why not? Their income statements are not that bad. Their free cash flow statements are not that bad. There's some investigative work to look into if they're making acquisitions and stuff like that. But they have major sponsorships. They have major sponsorships with top athletes. The Golden State Warriors just won the NBA Finals, and I believe they've won 4. I think the number was 4 out of the 8 seasons that they've played. That's 50% of the time they've gone to the finals and they've won and become champions. Steph Curry consistently becoming an MVP wears Under Armour. Where they're currently sitting, this might be just a rough period for them, but from a financial perspective, price makes sense. Now, am I saying go out there and buy Under Armour today? No, what I'm saying is there's still a lot of work to be done. There's still a lot of due diligence to be done, but this is the starting point, folks. This is the starting point. This price makes sense. Now, what we have to do is look at what's involved, what's at stake, who's running this business, where are they planning to take it, and if all of those things check out, it would be a buy for me and potentially for yourself. Hit that like button if you're loving it. Hit the subscribe button for more videos like this. The software that I have in front of me will be available for you to use as a tool, as it will be an app for you to use for my subscribers. There are more features that are planned to be on the way, and you are going to love it. You're able to screen companies in an instant. If you like to see a company evaluated, write it down in the comment section below. In essence, that's the video, and I'm glad that this worked out in terms of seeing a company that has been trashed. It's not looking too great on their financial evaluation section, but the price makes sense. And are these things that they can turn around? Who knows? But that's where the due diligence comes from. If you liked the video, folks, once again, hit the like button, hit the subscribe button. I will see you in the next one. Thank you so much for watching. Until next time.